Hey everyone, Chris Haddon, Jason Balin here with the Private Lenders Podcast, as always sponsored by our lending company, hardmoneybankers.com, and our mastermind group, hardmoneymastermind.com, for experienced and aspiring private lenders. Go check us out there. Today we're talking about capital. Another topic related to raising capital, which we've been going through a series of them recently, and this is going to be your investor targets, the main type of people in terms of personality type and also like common professions and stuff like that to focus on. If you're familiar with DISC personality profile, that will be helpful. If not, go check it out sometime. You can easily look it up on Google. Very, very useful. You can also take a personality test yourself if you want for free on Tony Robbins' website. Just Google Tony Robbins DISC. We've been using this forever, right? Let's start. I think we should start with DISC in general and how we've used it over the years and then kind of jump into that.
Yeah. No, absolutely. So obviously you have the D and the I and the S and the C related to that. And I guess for the purpose of this conversation, let's stick with the D and the S because, you can go research, what the I and the C are, but let's just talk about, right, the D and the S because those are
the targets. Those are the targets.
The two targets, and they both are they both kind of work separately. A lot of people in general overlap and have multiple targets. But yeah, so we'll talk about the D and the S, and then we'll jump in a little in a second related to some key characteristics with some passive investors that we work with, and then some active investors that we work with. And hopefully, as we're going through this, you can relate yourself to maybe some investors you've talked to in the past or some investors that you're currently working with. Hopefully they're not currently abusing you because you've raised capital from the wrong person. That's not necessarily a good thing. Or maybe you're chasing capital around right now, and this will potentially help you to determine if you should continue to close this person or just walk away because they'll never, ever invest with you anyways.
Yeah, hopefully this podcast and this topic in general shortcuts this process for you because we learned it the hard way. We found out the right people to work with and the wrong people to work with. And there haven't been all that many wrong people, but that's also because we caught on to this pretty quickly. And we were familiar and using the DISC personality profile and other aspects of business way before we started raising capital. We actually learned it in different jobs, but in sales training back in the day in our early 20s. It's useful for that in terms of like the people that you're trying to sell a product or service to, so that you know what they're like, what they want, how to approach them. Later on, we were using it for hiring and training people, right? For building out our team and having the right personalities in the right positions. And around that time too, we applied it to investor relations as well in raising capital. And it was a huge shortcut once we piece those two things together. And it's been like that for a decade now. And we've been teaching it to other people, using it ourselves, and it's just very, very consistent and stays the same, right? This is not the kind of thing, people are people, like they don't change like, I don't know, technology does, for example, like where everything's totally different tomorrow. So this was true back in the day. It's going to be true many, many years from now. So let's dive in. So we target the D personality and the S personality. Let's start with D. It stands for dominant. It is your type A business person, male or female. I'm sure there's an equivalent in every different personality sort of profile. And a few characteristics of these people is that they're often successful in what they do. They are often in finance, in real estate. They could be doctors, construction people, sometimes construction people. So whatever it was, you can tell right away that they have had a good amount of business success, and that's why they've accumulated some net worth. They have investable capital, and they want that capital to work for them. Some other characteristics of these people is that they're typically sharp, and they think quickly, and they see the broad strokes of whatever might be a business or an investment or whatever easily. You don't need to kill them with details because they get stuff intuitively instead of analytically. They make quick decisions. They want competent operators who they can trust. And then once you do have their trust and you do present to them well, they're going to let you do your thing. They're going to let you do what you're good at. They're busy people themselves doing what they're good at. And they end up being fantastic relationships, great capital investors. And they're probably going to be the majority of your capital base, like they are ours. Like probably, I don't know, I'd call it maybe 60, 70% of this personality type makes up our base of capital at HNB, which is outstanding, just a little under 40 million bucks, with more on the sideline. So Ds are important. You have to be able to work with Ds. You have to be able to associate with them properly if you're raising capital.
Yeah, and also I think one thing to mention is most capital investors that you target or you speak to will understand this business model. If not, have already been hard money lenders or have already lent capital out themselves. Right? This isn't the hardest business model to understand. Especially now, it's very, very common now. It's not uncommon at all for, someone to deploy some money in a self-directed IRA or some sideline capital or stuff like that. So they understand the model. But when we started, I wouldn't say that a lot of our capital investors or our D capital investors were hard money lenders, although some certainly were, but they did understand it very, very quickly. Like they got it, right? And that's part of it is they understand. Like if they don't understand the business model, they're just not going to be the right investor for you, right? It's not brain surgery. It's a very simple model, and they understood it. And I guess a real big benefit of working with these, and I think a lot of people take these as being sharks, or being aggressive, or potentially could turn into your boss because they're putting up the capital if it's not controlled right. But most of them are pretty transparent, and they are what they are, right? They don't need tons and tons of details. You can go over everything very, very quickly with them. They understand it. If the deal makes sense and they tell you they're ready to go, then they're going to be ready to go, and they'll help, and they'll put the capital in to make it very, very simple. So although there is a little bit heavy lifting kind of on the front end, because they want to make sure, that the deal's good, or you as a person's good and the business model's good. After you build trust and build a relationship with them, it's an easy transaction. Very, very easy transaction. So it's kind of a pleasure to deal with dominant personality types. And chances are, if you're watching this or you're listening to this and you run your own hard money lending company, you probably have a lot of D in yourself as well. So yep. And typically, sometimes the same personality types butt heads, but if you guys are speaking the same language and you're clear and understandable, it works. Now, I will tell you, if you put in front of them a bad deal, or you're unorganized, or potentially you don't know what you're doing, they're going to catch you in it and you're screwed. Right. Yeah. So you got to make sure you're doing things by the book in the right way, because the last thing you want is for them to, re-underwrite something behind you or catch you in something. And it might not be a lie, don't get me wrong, but like something that you missed, and then you'll lose a lot of credibility very quick. So make sure you have all your facts right, underwrite the deal, make it a good deal. And a D ends up being a real pleasure to work with.
Yeah, totally. And they will, that's a very good point, because they will ask the right questions even before you're actually looking at a deal. When you're, looking at your pitch deck and just going over what you do and what you're going to present to them, they're going to ask you the right questions, and you have to be prepared for that. What happens in this case? What happens in that case? How do you check on credit? Like, how do you do valuations? Like, they're going to ask all the right stuff because they're freaking smart and they know what's going on. So definitely have your ducks in a row. And another good point in there is that, yeah, it's true. When you're first raising capital and they know that, and you need deals to get funded by new investors, they will push for more. Like, that's their personality type. That's how they got to where they are, success-wise. And they're going to ask for a higher rate of return. They're going to ask for a point if they can get away with it. Or they might even push back on underwriting, be like, we should have a little less exposure. Maybe we should be at 150K, not 175, that sort of thing. And you have to stand up to that. You have to be the kind of personality that they want to interact with, that can push back and stand your ground, right? And I mean, first of all, you have to have, the right deals and have underwritten them correctly and yada, yada. But in some of it's like a little bit positioning. I don't want to call it posturing. That's probably a little strong of a word, but positioning in order for them to not take advantage of you in those ways. You have to be like, no, we don't pay points. Like, that's how we pay our own bills. Like, the origination fees, how we run our company, and the rate of return to you is 10. And that's just the way it is. Even if you do need it, even if you do need that deal to close in a couple of weeks using their money, you got to position in the right way. You got to stand your ground, even though it takes some cojones to do so.
Yeah, let's jump into S's a little bit. And originally when we started this conversation, it wasn't necessarily like D's are going to be active investors and S's are going to be passive investors, although that's kind of the reality. Yeah, one could say that is the case. But but again, we do have, as the business grows and as your business will grow, passive investor. There are a lot of passive investors that are still, active or D at hearts. But it's the trust factor, and they trust that you're doing it the right way. So, okay, let's jump into S for a little bit.
Yeah, let's talk about S. So S stands for steadiness. This is more of a passive type of personality. Oftentimes they've had some kind of maybe administrative clerical position, kind of the like executive assistant to hold down the fort. Like they're the glue. S are super important. They're the glue that holds the world together, right? And they're great at that. They're fantastic at that. Awesome people. Typically not all that into business and investing. Like that's not like where they focus their brain's energy on. And for that reason, they tend to be more of a passive sort of investor. Oftentimes they'll come from a referral, like a friend or family, like, hey, my, relative here or my friend needs to earn some interest income. They want to supplement their income. They've saved up some money. Oftentimes they're going to be older. And it's just a high trust relationship. They're not like, you could explain to them the entire file and they don't really care. And we've tried to, right? Like, let's make sure that you understand this. And it's not, they don't really care to understand it. They're more just trusting in you and your model and in the referral. And your job is to take care of them. Your job is to put their money into good deals and get them paid, right? Protect that money, keep it safe, keep it coming in, and they'll be super grateful, as all of the investors are. You put them in good deals. Everybody needs good deals. You put them in them, they're going to be super grateful. And it ends up just being a low maintenance, easy relationship. They make their money. They let you know when they have some more to invest. You let them know, like whatever your system is to, do status updates, whatever it may be. And it works. It just all flows smoothly and everyone wins.
Yeah. And there's obviously a lot of loyalty with the passive investors. And again, they're the type of person that they're going to trust you with their money early on. The first deal they want to be a little bit more involved in, obviously, but after you build that trust, there's a lot of longevity to it over and over and over. And they keep it really simple. And they like to brag to their friends and their colleagues and their family about the interest rate return they're getting, the investments that they're in. So it ends up being a good thing. So again, there's no real difference between, or there's no real preference, I would say, if you want to get an active investor or a passive investor. They both have obviously their pros at the same time. I think a lot of people in general, if they're raising capital for hard money or just real estate investments, I feel like they think they want to just attract passive investors because they don't want anyone to be in their business and to tell them what to do, and they just want to make it an easy transaction. But that's just not what it is. You can make this an easy transaction if you do it the right way. You have access and you find a good deal. You underwrite it appropriately. You put the right tools and resources and people in place. You have the proper updating for them. They'll make it easy. And I would say that over the longevity of a business, an active investor is actually a good thing. You could potentially try other opportunities in. It's not the end of the world if someone busts your ball, especially early on a deal, because typically they're smart and they're active and they understand the business, right? So because of that, you never know. Like they could potentially help you grow at the same time. So obviously you don't want to give them leverage to control your business. You start doing that with any capital investor, you're screwed. But it's good. So again, that's typically the two characteristics, like active, passive. Like we started the conversation with, I wouldn't really go after I personality types or C personality types. Yeah, all of your capital investors might have a mix of that as well as an additional personality type, but I wouldn't necessarily target that. I think that would be tough. And just like every other training video or mastermind or consulting video or any other videos you've seen in the past, it's so important to align yourself correctly with the right capital investors, because not only will it make your life easier on the front end, it'll make it substantially easier on the back end. If you put the wrong capital investor into a deal, right? Let's say, oh, well, I can get cheaper capital. I'm going to put this in here. Or he's the only capital I have available right now. If you put the wrong capital investor into a deal, that's going to be a recipe for disaster. Even if the deal performs fine, you're still going to have to do status updates, annoying questions and answers. And as soon as that deal starts going sideways, they're not going to be happy, and they're going to potentially, make your life miserable. And the difference is, if you have a good capital investor, listen, deals default. That's just part of the business, right? But if you have a good capital investor and you have a good relationship with them, even if they're active or passive, and you have a deal that defaults, they're going to be on your side. They have your best interest in mind, and they know that you're doing whatever you can to help clean it up to protect their money and protect their interest. So
see, that's the exact litmus test right there. Is if you get the sense in working with the investors that they are not on your side and they're like trying to blame you for some kind of situation or whatever it is in the transaction, even if things don't go wrong, you just get a sense that there's some kind of adversarial relationship, that is a big red flag, and it's not going to work out. It's not going to work out. So yeah, keep your eye on that, because it should feel the opposite way, that you are on the same team and you are in these deals together. And hopefully you even do throw in some dollars with your investors too. You're literally invested together, co-lending. And the relationship should feel like that. It should feel like you're on the same team, right? And if it doesn't, beware of that. And yeah, just in general, like backing up real quick to the personality stuff, just to wrap up here, like, you can have some I's in there, you can have some C's in there, even if it's not your target. But I think it's going to be very, very beneficial just to be aware of the personality types that you're dealing with. And then you're going to start applying that to other aspects of business and life, because people want to communicate with you differently. They want to be treated differently based on the personality types. And just being able to pick this out, just to being able to identify that, is so beneficial in so many areas too. And so we're not saying like never take on money from a C. We have C's. We have C personality types investing with us. They might not be our main target, but they could come on board somehow. So anyway, I think the main takeaway, besides on the targets, is just to be aware, just to be cognizant of how these personality types function and how you can best fit in with them.
That's right. Hopefully you guys enjoyed this week's Private Lenders podcast. If you haven't picked up the Hard Money Secrets book yet, I don't have one on my desk right now, so I can't show you a copy of it, but go to hardmoneyfreebook.com, and it's pretty much our entire business model inside that book. So you can pick it up, you can get your free copy there. And if you have any questions, feel free to reach out to us. And if not, we'll see you guys next week on the